Okay, so I want to start getting into valuation today. We spoke a little bit about it in the second or third day of the program, just kind of as an overview. I want to now get into it more formally now that we've built a full model on Walmart. And really the goal, the technical goal of these next few days is to figure out what the value is on Walmart, and then obviously really give you the transferable skills and the technical skills to be able to have you do this on the companies that you're working with, whatever transactions you're working on, anything after that, interviews, case studies, things like that. So first of all, when discussing valuation from a banking perspective, as you know, there are three major methods of valuation that I think you're all aware of. If you're not aware of, you should be aware of them, right? One is the comparable companies analysis. Two is the precedent transactions analysis. And three is the discounted cash flow analysis. And the point of these three methods is they all come from very different perspectives. When I say very different perspectives, I'm talking market perspective, book perspective, cash perspective, net income perspective. We'll talk about the different perspectives. And the point is, each of these methodologies are quite broad and have major flaws. But their flaws come with unique perspectives. And the idea is when running each of these three analyses, if you do so, and if each of these three analyses come to an agreeable range that determine the prospective value of a company, if they all point to a common range, then that common range should be supporting evidence to prove what a company would be worth. And remember, when you talk about valuation, it is quite subjective. For us, it's mostly talking points in terms of negotiating the purchase price of a business or the sale price of a business, and we'll talk about how that's utilized. So we're going to go through each of these methods. We'll talk about the concepts. We'll talk about the benefits of each, the weaknesses of each, and we'll use each of these in relation to Walmart to help determine what the company could or should be worth. So what was interesting is when I did this for Walmart in the beginning, Walmart was at $58, I think. And everything pointed to the stock has to go up. It must go up. There was nothing that was under that. And it did. It went up like $20 a share. Now it's a little bit different because it's kind of at $78. It's at where the valuation points to. So it's not going to be as clear. But the point is when you can see opportunities where all the valuation methods that you go through point to the stock has to go up or has to go down, and those are good investment opportunities, right? Given that there's not going to be any sudden changes to the financials. And so the point is to help identify those. So the first thing to think about, and this is what we discussed in the second or third day of the program, is each of these valuation methodologies helps us interpret what the company is worth by looking at multiples, right? And there's two types of multiples. There's market value multiples and there's enterprise value multiples. So I want to recap the discussion that we spoke about on this third day of the program in talking about what is the difference between market value and enterprise value and why. I think everyone knows the difference in the formula, right? Market value is what? Share price times share. Share price times shares. That's 10. Enterprise value is what? Market cap plus net debt. And the purpose of enterprise value is what? Why do we add? What value does adding net debt to market cap give us and provide for us? What value does it provide for us?
Providing the value of the PPE and the working
It's providing the value of the PPE working capital, providing the value of the operating assets of the entity, right? So big private equity. And if your question is, when you are taking market cap and you're adding net debt, yes, that gives you enterprise value, but net debt is short-term debt plus long-term debt minus cash. Why are you subtracting cash from net debt? Why does that give you enterprise value? And so, you know, we've spoken about the situation where, let's say we have a market let's say we have two values of a business. We have market value, kind of interchangeable. And let's say we have, let's start with book value, just to illustrate this, book value. Right? So the book value of an entity is the value of the business as determined by its balance sheet. That's the book value. So if you look at the shareholders' equity on the balance sheet, let's say that's 5, that's the value of the business to the shareholders as written up by the books. And you should have a better understanding now of how that comes to be. That grows based on your net income. Right? We did the income statement, cash flow statement, balance sheet flows, right? As you generate net income, that increases your shareholders' equity. Right? Now, you can equate that to market value. Market value is the share price times the shares outstanding. Right? Times shares outstanding. Number of shares outstanding. And that usually results in a premium that's higher than the book value of the equity. Why is that? Well, this value of the business is driven by the market. The shareholders determine this value. And this is usually at a premium to book value. Why? Why is the market cap of a business usually at a premium to book value? So, but now the big investment bank interview question is, well, why do you subtract cash from that? Why do you subtract cash from net debt in enterprise value? And when you look at this formula and say, okay, well, let's take market cap and add short-term debt plus long debt minus cash. Right, what does that mean? Well, if we want to subtract do minus cash, and market cap plus short-term debt plus long debt, I'm going to rewrite this to make it easier to read. Market cap plus short-term debt plus long-term debt, right? If we do minus cash, to get minus cash on this side of the equation, we have to subtract cash from this side of the equation. We'll cross that off. And so what we have here is we have market cap plus short debt plus long debt minus cash, or net debt, equals PP&E and working capital. So basically, if you're going to subtract cash here, you're going to subtract cash from here, and what you're left with is PP&E and working capital, or the core operating assets of the business. For us as an investor, that's the important piece that you want to value. You want to value the assets that are operating that will produce future value in cash. That will hopefully lead to giving us a return. That's the point. So when a lot of people say, well, why do you subtract cash from net debt when calculating enterprise value? A lot of people say the wrong answer is, well, because cash pays down debt. That's not true in valuation. That's true in the transaction, but that doesn't happen in valuation. Valuation, no debt's being paid down. Valuation, you're just analyzing what the value of the entity is. You're not changing the balance sheet. You're not writing down debts. The reason is because when you're subtracting cash from long-term debt, you're left with the implied value of the operating assets of the business. And we explain that in Chapter 7 of the valuation textbook. So it's important to understand that. Any questions on that? And so why it's important to understand this breakout is because these days there's a lot of items on the balance sheet that aren't this simple. And a lot of people are left confused with what do I add back, what do I not add back, what am I supposed to add back to get to enterprise value? And we'll slowly build to that. I mean, let's just introduce the basics right now. But if you have intangible assets, for example, or goodwill, do you value that? Is that important to you? Or do you not value that? If you add it, if you subtract, if you don't want it to be part of your valuation, you subtract those assets from your net debt. If you subtract it from net debt, it comes off of here. So you want to be left with the core value of the assets of the business, whatever you deem to be operating. And we'll slowly get to that. I don't want to get too complicated yet. But that's the situation, especially with technology companies and things like that. So when the key thing about valuation in this class is not just to rattle off all the stuff that you read about in business school, it's to really explain why the stuff is, because it's changing. Right? Last year I did a whole thing with Groupon, with the M&A team at Groupon in San Francisco, about rewriting all these formulas. And then everyone got fired. Not because of this, they were all physics majors. Because they wanted to aggressively acquire small tech businesses, but they didn't know how to value, so we went through all this stuff, but then they just disbanded the whole strategy team. But it was interesting. It was good. It was all about how do you use these traditional formulas, but break down the concepts and restructure them to think about how do you think about valuation for tech companies when there are no hard assets. And the same structure of the formulas exist, but it's based on understanding what enterprise value truly is and what are the operating assets of the business. So for Groupon, it's customers, less churn, and it's all the stuff that we kind of went through. And it was important. It was important. It worked for them. They aggressively acquired stuff for like a year, but then, you know, they're up and down now. I don't know what's going on there in the news. But anyway, so the first point is long debt plus short-term debt minus cash. And more importantly, when you talk about how this pertains to multiples, and again, we spoke about this on the first day, every valuation analysis leads to some sort of multiple, right? There are market value multiples, and there are enterprise value multiples. What's the difference? First of all, multiples compare market cap, tradable metrics, with some underlying income statement driver or asset driver. Right? What's the point of that? It gives you a metric that determines how much an item or an entity is valued in relation to what it's producing or what its value of underlying assets are. And so from an arbitrary perspective, these multiples really don't have meaning. But they have meaning when you start comparing them to other companies. We started to learn this yesterday when we talked about raising equity, raising debt for Walmart, and looking at the PE multiple. So part of this valuation course is to help you determine how do you use these multiples as a tool. And so when looking at market value multiples, you compare market capitalization to underlying line items that are after lenders have been paid. So that's why we see market cap in relation to net income. Market cap is based on the stock price, which is based on the price of a business after lenders have been paid. So is net income. Net income is the earnings of a business after interest has been paid. If you want to use enterprise value, however, as a measure of value, and we just explained why you'd want to use enterprise value, because you want to use enterprise value because it's a measure of just the operating assets of the business. So if you want to use enterprise value as a measure of value, you cannot compare enterprise value to net income, because enterprise value is plus net debt before lenders have been paid, and net income is after. So if you're looking at enterprise value as a comparable metric, you want to divide that by a metric that's before lenders have been paid, or EBIT or EBITDA. So when using enterprise value as a comparable metric in a multiple, you can only compare it to an underlying income statement or asset metric that's before lenders have been paid. That's why we have enterprise value to EBIT, enterprise value to EBITDA, enterprise value to sales. When looking at market capitalization, you want to compare it to a metric that's after lenders have been paid. That's why there's market cap to net income, market cap to earnings, market cap to book value. So when we go through the valuation analysis, we're going to talk about how these multiples can be used as a tool based on each of the three methods. Any questions on the multiples? I think it's more important to use them and play around with them for you to understand best how they're going to work. So applying those to the three major methods, the first method we're going to look at and analyze is comparable companies. The comparable company analysis compares companies that are similar to the one that you're valuing, similar in size and in product, in scale, and in geography. And what we do is we will look at companies similar to the one we're analyzing. So we're going to look at companies similar to Walmart, and we're going to create multiples, market value multiples and enterprise value multiples on all of these companies. And we're going to compare those multiples of our company's competitors to our company. And we're going to use those multiples to determine if our company is potentially undervalued or overvalued. Okay? So if our competitors' enterprise value to EBITDA multiples are at a range of 7 to 10, and our company's multiple is 13, much higher than its competitors, it could be that our company is overvalued. If our company's multiple is much lower than its competitors' range, it could be that our company is undervalued. That's the way we kind of generally think about it. Now, and we'll go through this in complete detail, but generally the comparable companies analysis has major benefits and major flaws. First major benefit, it's current. It's the only one that's really, everything is based on the current stock price, yesterday's close. So it gives you a real current perspective of what companies are worth. It's not really based on the book, it's based on the underlying stock price. That's a benefit. So you would be asked, name the 3 major methods of valuation, what are the benefits and drawbacks of each? You might be asked this in an interview. So it's the public analysis of the 3. I mean, the other analyses have some public components to it, but this is the major public analysis. Disadvantages, might be hard to find comps. It's true for Walmart. It's so big. We'll talk about how to run it anyway. Or if you have a private company, or a company that's so unique that you really can't find true competitors. It's a drawback. 2, the whole industry might be overvalued or undervalued. So if you are analyzing tech companies and its competitors are all trading at like 100 times PE, and your company trades at 50 times PE, but all these numbers are so exorbitantly high, does this analysis make sense at all anymore? Right? To put this into perspective, the S&P 500 trades on average at 15 to 16 to 17 times PE. So companies that have like 100 times PE, which is true for a lot of tech companies, are just way out there. And we'll talk about the implications that value has. So the analysis is flawed if the whole industry is overvalued or undervalued. So what we're going to do is we're going to look at potential competitors as similar as we can get to Walmart. We'll run comps analysis for each of them. We'll look at the range. We'll compare that range to Walmart, and that'll help us determine what the potential value of Walmart could be. Any questions on that? Second analysis is a precedent transactions analysis. This is looking at transactions similar to the company that we're analyzing. So if we're looking at a big box retailer, let's look at past acquisitions of big box retailers and determine how much acquirers have paid for that company. The price that acquirers have paid for that company could determine what the relative value of our company should be. If somebody paid 10 times EBITDA for other big box retailers, then our company should be worth 10 times EBITDA. That's the idea. That's the idea. There's a lot of major flaws. Well, there's benefits and flaws to this analysis. So what we'll do is you've got to go through Google searches and news runs to find acquisitions of companies similar to the company that you're analyzing. You need to pull up those proxies and reports at the time of that acquisition to determine multiples that look at how much that company has paid for the business. So the multiples you look at, PE, enterprise value to EBIT, enterprise value to EBITDA, are the same types of multiples we looked at in comparable companies. PE, enterprise value to EBIT, enterprise value to EBITDA as examples. But it's a different perspective. In precedent transactions, we don't consider these market multiples, we consider these purchase multiples. It's the same type of a formula. You're taking the price divided by earnings, but it's not the price that the company is trading at, it's the price paid for the business. When we look at PE, it's the price paid for the business divided by the earnings of the business. Whereas in a comparable companies analysis, the PE is the price that the company is trading at now divided by the most recent earnings of the business. PE in a precedent transaction is the price paid for the business divided by the earnings that the company produced at the time. So you can say, well, XYZ fund paid 15 times the company's earnings. They paid 15 times the company's earnings. That's what they paid for that business. Let's take a look at that. What benefit that can have is purchase multiples include a premium, because we'll look at when we talk about the M&A course that acquirers typically pay a control premium, which is a significant premium above the current market trading value, significant enough to convince shareholders or the owners of the business to let go of the business. So these multiples tend to be higher than the current market trading multiples, and that could be a benefit if you're using this for M&A analysis. It includes a premium, which could give you a premium estimate if you're analyzing this business because you might want to acquire it. Drawbacks of precedent transactions analysis is it's very difficult in many cases to find transactions that are similar to the company that you're analyzing, especially in today's market when M&A isn't as prevalent as it was 10 years ago. Or if a company like Walmart that's so big, does it really make sense? Are there people really buying companies this big? Not really. So one of the biggest drawbacks is it's tough to find transactions or acquisitions of businesses that are similar to the business that you're looking at. It's one big disadvantage. Second is the analysis is historical. So even if you do find transactions, they could be dated, right? They could be from last year, from 2 years ago. So a lot of times the environment might have changed, the market might have changed. It might not give you the best indicator of what an acquisition today might look like, what the value today is. So, as analysts, it's often very difficult to put this together. Not because of the math or because it's technically complicated. It's just tough to dig for that information. And even if you do find like transactions, sometimes it's tough to find underlying data for the acquisition at that time. So we'll go through an example. So a lot of times nowadays when you're throwing it in a pitch book or something, this analysis can be thrown out. But I'll give you good techniques as to how to find and dig up some of this information. Third, discounted cash flow analysis. This is taking a company's future cash flows and projecting it back to current value. Right? And notice when we do use a discounted cash flow analysis, we take a company's unlevered free cash flow. We'll talk about what that means. But why do we look at cash? Why is it discounted cash? Why is it not discounted net income, for example? Say again, Tommy? Because of what?
The company can continue to generate cash.
The company can continue to generate cash in the future, but it can continue to generate net income in the future. What's the difference between cash and net income in this case? Why would an investor be concerned more about discounted cash flow? There are some situations where you might consider a discounted net income. Maybe I'm not a real estate expert, but I've heard maybe real estate. But why discounted cash? Might be asked this.
Net income includes non-cash items.
Net income includes non-cash items. To an investor, net income has, expendable items that might not really represent your cash flow. Net income can have revenue in there that you didn't actually collect. So to an investor, cash is really indicative of what the company is producing and indicative of helping determine when an investor could get paid back or could get a return on his investment. That's why. And that's further why we look at unlevered free cash flow. We'll explain unlevered free cash flow, but unlevered free cash flow is just the cash that's producing from the operating assets of the business. Kind of in tune with what we spoke about just before. An investor wants to see just cash from the operating assets of a business because those are the assets that will clearly produce cash in the future. I don't want my cash flow to be masked by debt raises and other extraordinary events that might make it look like I'm producing a lot of cash when I'm really not. So we'll look at that. So we're going to take the company's cash flow projected out a certain amount of years, which we've already done for Walmart, but we'll do it in a special way. Discount it back to present value at some discount rate. We'll talk about what the discount rate is, but from a high level. The advantage is the most technical of the three. So, in contrast to the comps analysis, which is based on the stock price, this is based on our model. It's based on what we actually estimate to be produced from cash, independent of where the stock is. So very different. This is where I say, all these techniques come from very different perspectives. So if you do a model based on cash and you come up with a valuation range, and you compare that with a model based on the stock market prices, which is completely independent of this, and they both come to a similar valuation, pretty good indicator that that's where your company should be valued. Disadvantage is, there's a few disadvantages. One major one is the company's projected cash flows. So you project the cash flows for the first 5, 7, 10 years. Everything after that, we come up with this terminal value that's representative of the value of the business from year 7 to out into perpetuity. That's a large portion of the value of your business, and that's based on just either a multiple or the standard perpetuity formula. So although the first 2 years is quite technical, the rest could be quite arbitrary. So we'll talk about the different techniques, and we'll talk about this in a little bit more detail. Those are the three major techniques: comps, P-pays, DCF. Comps based on the market, P-pays is based on past acquirers, and DCF is based on your model. So we're going to go through each of these methods for Walmart. We're going to dig into them in detail and hopefully help figure out and determine where Walmart's stock price should be and see how that compares to what the streets are. Any questions? Okay. So we're going to start with talking a little bit more about the discounted cash flow analysis. And when thinking about the discounted cash flow analysis, again, we mentioned what you first do is you project out the company's cash flow. And we briefly talked about the unlevered free cash flow. Excuse me. And we spoke about, from a high level, what unlevered free cash flow is. Let's discuss it further. And actually, I was going to do this on the board, but I'm going to change my mind. So let's do it. I'm going to do it in the model. What is unlevered free cash flow? Just from the definition. What do I mean by unlevered and free? What's unlevered cash flow? What's free cash flow? What does that mean? And why do we care? It doesn't include debt, right? Unlevered is before the impacts of debt. That's unlevered. What makes it free?
Free cash flow shows your cash generated from operating activities plus your free capital investments.
Yeah, but why? I know they get the formula, but what's the meaning of it?
It's available to spend.
Based on what? Yeah, it's the cash most available to be expended, in this case for investors, based on what though? Produced how? Anybody? Produced from the operations of the business. Void of extraordinary items. So how do we get to the free cash flow of a business? And that's what that slide is trying to represent. Well, let's take the cash flow of a standard business, right? Here's Walmart. And so let's break this down. So let's say when I want free cash flow, I want cash before lenders have been paid, cash before equity holders have been paid, cash before dividends have been paid, right? I want cash that's expendable. So when doing that, I'll eliminate anything from short-term debts, anything from payments of common stocks, anything from issuance of common stocks. Basically, my whole cash flow from financing activities section would be eliminated. How do I eliminate purple? Gone. I don't want anything relating to financing activities because that's payments to lenders and equity holders. When I take a standard cash flow and build to unlevered free cash flow, I wipe out all payments to debtors to equity holders. What else do I pay out? Do I eliminate? I eliminate anything that's extraordinary in the investing activities, any one-off investments, any divestitures, any M&A activity, anything that's not related to the core operations of the assets. So I'm going to eliminate everything in the investing activities. I'll leave CapEx though, because CapEx is, as Alex was saying, key to the operations of the business, arguably. Okay? And I'm going to wipe out anything that's extraordinary, not based on everyday operations. So I'm going to wipe out discontinued operations, this other operating activities, and then extraordinary and non-standard. When you take a standard cash flow statement and wipe out anything extraordinary, anything based on one-off investments, based on payments to lenders, payments to equity holders, what are we left with? We're left with net income. We're left with depreciation and amortization, deferred taxes, working capital, everything based on working capital, and CapEx. That's it. Those are the major components of unlevered free cash flow. And so when you look at the slide here, what I'm doing is the same thing. I'm taking just a simplified cash flow statement and crossing off everything related to financing activities, anything related to other investing activities except CapEx, just like we did with Walmart. And what are we left with? When you look at the left, you're left with net income, depreciation and amortization, deferred taxes. Maybe I threw in some other non-cash items if they're not extraordinary. Working capital, less CapEx. That's what we just did in Walmart, right? We were left with net income, depreciation, deferred taxes, net income, depreciation, deferred taxes, change in working capital, less CapEx. Same idea. But I added something here, which you need to add, is to make this completely unlevered, because net income is naturally after interest, you need to add back after-tax interest expense. That's how you get from cash flow to unlevered free cash flow. And that is the formula for unlevered free cash flow. So it's important for you guys to see. You don't have to memorize this formula. It should make sense by taking a standard cash flow statement and just breaking down the components. You might see cash flow statements that are completely right. And why this is important to note is because there's a major confusion and misconception in working capital. A lot of people say this and say, well, this is wrong. You're supposed to subtract changes in working capital, right? But basically, when you see minus changes in working capital, what they're saying is, well, if you take the balance sheet changes from year to year, if an asset in the balance sheet is increasing, you need to subtract that in the cash flow statement. So to avoid confusion, all I'm saying is if you look at the way the cash flow statement is broken down, just do what the cash flow statement does. If the cash flow statement is adding working capital, which our cash flow statement does, then you add working capital. Our cash flow statement is adding the negative working capital. That's the point. The point a lot of people get confused by the signs here. Just you are doing what the cash flow statement does. You are replicating the cash flow statement, but simplifying it and keeping what's core to the operating assets of the business. Any questions on that? This is also going to help us figure out, which confuses a lot of people, what do you mean by other non-cash items? How do we know what other non-cash items do we include or do we exclude? This is a mystery for a lot of people. You should start to realize, it's very simple now, if there's any adjustments to the operating cash flow statement that's based on operations, you would include it in this analysis because we want cash flow from operations. If it's extraordinary or based on other investments, you do not include those other non-cash items into the analysis. Very simple, because the point is we're trying to get to a measure of cash that's produced from everyday operations. Now, you may say, well, the discount unlevered free cash flow analysis that I know does not start with net income, it starts with EBIT. So, okay, so fine. Let's say, thinking about the same exact formula, let's say we're starting with EBIT and not net income. What adjustments do we make to get to the same value if you're starting with EBIT rather than net income? And really what I'm asking is, well, what's the difference between EBIT and net income? What is the difference between EBIT and net income? It's not on the slide. What's the core difference between EBIT and net income? Interest and taxes. Net income is after interest and after taxes. EBIT is before interest and before taxes. So if you're starting with EBIT to get to the exact same unlevered free cash flow number, you still add depreciation, you still add changes in deferred taxes, you still add other non-cash items if necessary, you still add changes in working capital, you still subtract CapEx, The only difference is you don't add after-tax net interest expense because EBIT is already before interest, but you do have to subtract taxes because EBIT is not after taxes. Net income is after taxes. And it's important to note the taxes that you calculate in the unlevered free cash flow is not the tax number from the income statement. A lot of people make that mistake because the tax number on the income statement has interest expense buried in there. We want taxes as if interest expense was never in that metric at all. So we'll take EBIT, which is before interest, times the tax rate. So this is the formula you know. This is the formula that you've probably learned about in unlevered free cash flow. It's EBIT plus D&A, changes in deferred taxes, other non-cash items, changes in working capital, less CapEx, less taxes. And you should now understand where that formula comes from. Right? It's just a simplification of the cash flow statement. Yes.
And the after-tax interest expense on the other side, that's just the interest expense times the tax rate?
Times 1 minus the tax rate. That's right. So that's the formula. So we're going to create that formula and project that out 5, 7 years and discount it back. And that'll determine the current value of the business for 5 years, for the next 5 years, next 7 years. Any questions on that? So that unlevered free cash flow is projected for X years, right? 5, 7, 9, depending on the life of your model. So with Walmart, we did what? So a 7-year model? I recommend 5, 7 years. I wouldn't do, a lot of people argue the further out, the less accurate your model becomes. I usually typically just do 5 years. And then we need to establish a terminal value. So we project out the model for 5, 7 years, discount that back to present value. That gives us the value of the business for 5, 7 years. But then what about the value of the business after the projected year, after the last projected year? This is where terminal value comes in. So the terminal value is a way to estimate the value of the business after the last projected year. And there's 2 common ways of doing that. You can apply a multiple. So there's the multiple method, most commonly the EBITDA multiple, or there's the perpetuity method. So I'll explain it, and then we'll do it. Right? So I'll start with, so the multiple method, I thought I had a slide on it, I guess not. The multiple method is taking the last year's underlying metric. If we're going to decide to use the EBITDA multiple, we'll use the EBITDA. If we decide to use EBIT multiple, we'll use EBIT. Most of the time, we just use the EBITDA multiple. We'll take that last projected year's EBITDA and multiply it by multiple. The multiple times the EBITDA will give us a value of the business. And the implication is that's the expected value of the business at that point in time. We've projected EBITDA in 2020 to be $100,000. We apply a 10 times multiple for that, so the business at 2020 would be worth $1 million. 100,000 times 10. So the idea is at 2020, the business will be worth $1 million. This is kind of a banker's method. This isn't a textbook method. This is kind of come around through investment banking. The idea is with an EBITDA multiple is in 2020, we could sell the business. Think about purchase multiples. Well, we can sell the business for 10 times EBITDA. And whoever buys the business, that's the value of the business to him, so that's the value of the business to us 5 years from now. That's the idea behind it. It's important to think about that perspective. A lot of people don't think about that. So where do we get that multiple? We'll use comps. We'll look at, precedent transactions. We'll use the other methods of valuation. You can also look at just the current, as a conservative method, you can look at the current multiple of Walmart and assume that that multiple won't change. We'll look at various methods. But the idea is you apply that multiple times the final projected year's EBITDA. That'll give you a value of the business. But that value of the business is in 2020. So you have to discount that value back 5 years. And that's the present value of that business. So we got a couple things going on. We first have our model. where we projected 5 years of the business and discounted that back to present value. Then we use the terminal value multiple to get the value of the business after year 5. We'll discount that back to present value, and then we'll add all that together, and that's the value of the business to us. That's one way of doing it. The other way of calculating the terminal value is the perpetuity. And perpetuity is just a mathematical series where you come up with the value of the business at 2020, and that will slowly converge, right, to 0, or it'll never get to 0, but over an infinite amount of time. And the formula of a perpetuity is just taking the last year's cash flow. You take the last year's cash flow now, the unlevered cash flow we've projected, times 1 plus G, which is some minimal growth rate on the business, minimal growth rate on cash, usually the rate of inflation, gross domestic product, some small, commonly it's 3 to 4%. Nowadays I would make it even smaller. Sometimes I use 0.5 to 1%, depending on the expected growth of the business, divided by R minus G, where R is the discount rate of cash and G is that same growth rate. We'll talk about the discount rate and things like that. That's the formula. And we'll run that formula. That'll give us a value of the business from the last projected year out to perpetuity. And we discount that value to present value. And we'll add that to the first 5 years of the cash flow of the business, and that's the value of the business based on the perpetuity. So we're going to do it both ways. And we're going to value Walmart. We'll do it after the break. We'll value Walmart both ways, using the terminal value, using the perpetuity as a terminal value, and then using the EBITDA as a terminal value, and we'll compare the two. Sometimes they don't match. In my opinion, they should match, and we'll talk about the benefits of one versus the other, the implications of one versus the other. So a lot of times we have, like Alistair, for example, had a model test on Monday for a firm that he was interviewing for, and they said that we prepared to build a 3-statement model with DCF using 2 methods of valuation, and they meant using the perpetuity and the EBITDA method. So it's important to know this.
How long did they give you?
They gave him 75 to 90 minutes, which I thought was really short. It's usually 3 hours. Yeah, so I think what my recommendation was, they probably gave him a model with all the hard codes in, and a 3-hour one is more case study oriented, where you have to pull up annual reports and lay out and rearrange everything. So I believe that they gave him one that was already kind of prepped. That's why with that amount of time, it's crazy to think you can build the whole thing and do valuation. Which is why in our next exam, not Monday, our next exam is going to be DCF. 2 methods. It's a case study. It's a case study that one of you guys gave me about 3 years ago that had a final round at Goldman Sachs, and I reworked it. So good prep for you guys. Okay. So that's the process. What rate, how do we discount each of the cash flows? We'll use the weighted average cost of capital. We'll get into this discussion on Monday. For now, we use just 10%. But what I want to do, and what we will do, is I want to look at, let me undo all my highlighting here. I want to look at and be prepared to use the Walmart model. If you scroll to the right, I'm going to start with the DCF analysis. And we've already laid out everything, but this should hopefully give you a better perspective on what we're going to do with Walmart. We're going to use 5 years of projections. We're going to lay out the unlevered free cash flow using the same formula we just identified, EBIT plus D&A, deferred taxes. Other, we're going to help determine what to pull in as other. Again, it confuses a lot of people. Hopefully, with the new perspective, we'll have better understanding as to determining what we need to pull in for other. Changes in working capital. You should hopefully have a clear understanding as to should it be plus or minus. It confuses a lot of people. Again, just do whatever the cash flow statement does. You're replicating the cash flow statement. It shouldn't be a mystery. CapEx, taxes, unlevered free cash flow. We'll discount those values to present value. Forget about the WACC for now. We'll just use 10%. Next week we'll talk about the WACC. And then we'll use the term, we'll calculate the terminal value both ways. EBITDA method, perpetuity method, come up with a value. We'll talk about it. That's what we'll do after the break. So let's take a break now, and then we'll get into this. Make sure you have this model all ready and prepared. Okay, let's start kind of taking a look at what we've modeled for Walmart and start to calculate the unlevered free cash flow. So basically, you're going to follow this template, as you always would, starting with EBIT. So we're going to pull in the EBIT, and again, we're going to be calculating this formula on the right. We're replicating this formula on the right. EBIT will come from the income statement starting in 2013. So we'll pull this in from income statement 27888.4. The EBIT. Copy that to the right. That's the only thing you should be pulling from the income statement. And just to keep with the theory of all the adjustments that were made, we will make is from the cash flow statement. This is the only thing you should be pulling from the income statement as a starting point, EBIT. And then let's get to depreciation. Depreciation, cash flow statement, 85917. Deferred taxes, 7073. Let's skip other for a second. I want to get into that discussion later. Changes in working capital. Very simple. Just the total is fine. Net change in working capital. Don't negate this. A lot of people say, oh, it says in my textbook, not in this book, but minus change in working capital. I'm going to negate this, and it's wrong. You're sticking with what the cash flow does. Why you might read in textbooks minus change in working capital is because they're talking about the balance sheet changes. I don't know why they confuse things like that. Change in working capital. CapEx. Yeah, and taxes is EBIT times the tax rate. Very important that you're not pulling taxes from the income statement, because taxes in the income statement contains tax deductions from interest expense. You don't want that. So we're going to take EBIT and multiply it by the tax rate, making sure you're using the same tax rate in that specific year. EBIT times the tax rate, throw a minus sign on that to make it negative. And I'm going to add everything up, even though I had left out that other for now. And I'll give you a few minutes to catch up. We'll talk about other. Okay. So now looking at other. Let's go to the cash flow statement. Remember, we do want to replicate the cash flow statement and properly make adjustments the same way the cash flow statement is making adjustments. But remember, we're making adjustments to EBIT and not net income. So some things might be different. And you also have to remember that the adjustments that we're making are supposed to represent the operating assets of the business, or based on the operating assets of the business. So when looking at the cash flow statement, we've adjusted for net income, depreciation, deferred taxes, and all these working capital items. We did not adjust for discontinued operations. We did not adjust for other operating activities. So the question is, should we? And let's start, I mean, this is trivial because it's 0, but if this had value, would this be an adjustment that we would make in the cash flow statement? What do you think? Nick says no. Anyone else can weigh in on that? Boss's mill. Why not?
It's not going to happen in the future.
Number one, because it's non-recurring. Let's say if it was recurring. So right, because it's non-recurring, it's not core to the operating assets. So no. Let me make it more complicated. What if this was recurring?
It still doesn't represent what operation you're doing currently.
Right, because it's extraordinary.
That's yeah.
Right.
It's extraordinary. It just happens to be going on multiple times.
Because it's based on discontinued operations. Right. It doesn't, right. Even if it's going on multiple times, it doesn't necessarily mean that it's core to operations, like what Paul said.
It doesn't represent the present operating.
The present operating assets. Perfect. It doesn't represent the present operating assets. Absolutely. Now let me take it to a third degree of complexity, and let's say that it did. Let's say that this was, the sale of trucks. Get into Colt's comment from a couple weeks ago. That sounds extraordinary, but is routine. How would you think about that? Would you? Okay, and I'm kind of throwing you off on purpose. You want, in that situation, if it's not extraordinary or recurring, you want to think about where it's being impacted on the income statement. Because remember, we're starting with EBIT. So you want to ask yourself, is this an expense that's impacted EBIT? So in other words, because this expense, whether it was recurring or extraordinary or even not, just because the idea that that expense was removed from net income, way down below, and it didn't have to be extraordinary or non-recurring, because it was removed from net income, meaning our EBIT already contains that expense. Adding it back would effectively be double counting. So you want to be careful about that. So let me say that again. So this was a line item. We had net income. I'm trying to think of where it happened. Here it is. So we had net income. Then let's look at 2012. Then it's been removed. Right? You go to the cash flow statement. Cash flow statement takes that net income and adds it back. Right? If we're starting with EBIT, that line item was never removed in the first place. So you definitely don't want to include it, because if you were to include it in the cash flow statement, you're adding back an expense that was never removed from EBIT at all. So you would effectively be double counting. So no matter what that line item was, just because of the fact that that was an expense that was never removed from EBIT, you do not want to add it back, because if you do, it'll be double counting. That's a little bit more advanced, but I wanted to brush on that idea. So I'll explain it again, right? So here's net income. After net income, they removed discontinued operations, and this was the line item that began the cash flow statement. So we used this 16387 that began the cash flow statement, and we said, all right, well, this 16387 had a line item that was non-cash. I'm going to add it back. So it's going to add back 67, right? Because this 16387 was reduced by that 67. But if you're starting with EBIT, EBIT never had that 67 removed from it. So if you took EBIT and added back 67, you'd be double counting, because EBIT never had that 67 removed from it. This had that 67 removed from it. So you want to be careful about acknowledging where your starting point is. Your starting point is EBIT. So the first question you want to ask yourself is, are these other line items removed from EBIT to help determine if it should be added back? So a better example of that is other operating activities. Right? This is most likely an add back to some SG&A expense, because of the nature of it being an operating activity. It could have been an adjustment to other income, but Walmart didn't produce any other income, not noticeably. They did interest income, but not other income. The only thing that could be impacting is something that's in operations above the EBITDA line item. This must have been some expense that reduced EBIT that's adding back to EBIT. So based on that, what should we do? We should use it. It's important to start thinking about that. This is complicated. We'll do this in many different ways, but I want you to at least start realizing how to think about it. This is kind of like associate stuff, but just most importantly for your interviews and for your work is to be able to lay this out. So for that reason, I would include the other operating. I would not include the extraordinary. And this should properly represent cash being produced from the business, starting from EBIT for 5 years. Any questions? Make sure you have that. I'm going to save it. Now we're going to discount each cash flow based on some discount rate. Typically, the discount rate we're going to use is the weighted average cost of capital, but we'll discuss that next week. For now, let's just use 10% random. An average discount rate, WACC, is 9 to 11%. And we're going to use whole periods. 1, 2, 3, 4, 5, meaning the cash flow that comes in 2013 will discount by 1 full year, 2014, 2 full years, 2015, 3 full years. This is the end period convention. There is a mid-period convention, a mid-year convention. This is the end-year convention. There's a mid-year convention, which states that we'll discount only by a half a year in the beginning, then by 1.5 years, etc. What's the difference in the mid-year and the end-year convention? What difference does it make?
It's going to actually raise the cash.
Right. If you're discounting less, obviously, the present value would be less. But why mid-year versus end-year? What's the idea behind that? What's the idea behind mid-year versus end-year? I mean, the implication with the end year is that this $15 million is going to come in one lump sum at December 31st. You're discounting that whole cash flow by 1 full year. And then there's the belief, well, it doesn't come in one lump sum. It trickles in on a daily basis. So discounting not by a full year but by a half of a year is an average of sorts. I mean, this is where a lot of times the DCF, where do you stop with the engineering of it? Some people believe to use the mid-year convention. Some people believe to use the end-of-year convention. It's just important to recognize the two. Mid-year convention assumes, well, this unlevered free cash flow won't come in a lump sum, so we don't discount by 1 full year, discount by a half, sort of averages this, and so on. Okay with that? Okay. Discount, the formula for discounting, we'll do this in G17, is by taking the cash flow divided by, open parentheses, 1 plus the rate, to the power of the period. G14 is the cash flow divided by, open parentheses, 1 plus the rate, close parentheses, to the power of the period. And you want to anchor the reference to the weighted average cost of capital, or to our now 10%, so that we can easily copy this to the right. So we're going to discount each cash flow. Any questions on that? Okay. And so the total net present value of the business over 5 years is a sum of these discounted cash flows. So $59 billion is the present value of the business for the next 5 years. That's the idea. And so we're going to add this to the terminal value. And we're going to calculate the terminal value 2 ways. One using the EBITDA method, one using the perpetuity method. So for the EBITDA method, we take the final year EBITDA. We calculate EBITDA, so that's going to be equal to EBIT plus D&A. We're going to apply a multiple to this. That'll give us a terminal value and expected value of the business after 2017 into infinity. We're going to discount that to present value. The question is what multiple to use. Sometimes we'll look at the comps. We didn't do the comps yet. We can also calculate the current enterprise value of the business. Let's do that. As a default, in the beginning, we can calculate the current enterprise value of Walmart. So I want to use some things on the right here. So this box is basically for calculating the cost of capital, which we'll discuss next week, but at least the debt, the stock, the share outstanding, the equity value doesn't help us calculate the current market cap of the business that we can utilize. So I want to pull in the stock price. The stock price we had hard-coded, if you remember, on the income statement. So let's pull in the stock price in the income statement. I want to calculate the market cap and the enterprise value of Walmart. Pull in the share price. I'm going to pull in the diluted shares outstanding. Market cap, WACC, multiples. We want to look at the diluted shares outstanding, most current, which is the one that we've projected, if you remember, using the treasury method in the very first week. Here's the diluted share calculation. Total diluted shares outstanding. That's the one we want to calculate. Divide it by 1 million, though, so we can have like units. And so we multiply to get the equity value. Stock price times shares outstanding. $248 billion is the market cap of Walmart. And to get from equity value to enterprise value, we take the equity value and we're going to add the net debt of the business. Total debt less cash. I wish I had included a place for net debt. Here's total debt. Let's include the total debt here. This is total debt that's going to be used for a WACC calculation later. Let's at least put total debt. I want to avoid so many calculations in one cell. So the total debt, the year-end 2012 total debt, we'll go to the balance sheet for. Well, I guess you can go to the debt schedule. And the total debt is going to be the long-term debt under capital leases plus the long-term debt plus the short-term portion of capital leases plus the long-term debt due within 1 year plus the short-term debt. It's the 5 pieces of debts. 5, 3, 4, 2, 7. That's total debt. That's not net debt. Total debt is going to be used for WACC. But net debt is total debt less cash. And the formula for enterprise value states it's your equity value plus net debt plus minority interests as well. There's other things that go into enterprise value we didn't talk about yet. I'll give you a good investment banking interview question after this that'll help flesh out why minority interest. I'm slowly expanding on what enterprise value should be. I'll give you a reading over the weekend, but we'll slowly dig into that. But the true value of enterprise value, the true definition of enterprise value is market cap plus the net debt plus some other things. Other things including minority interests. I'll explain why. But so, to make it simpler, I'm going to calculate here net debt, even though this isn't in the book. Net debt is going to be equal to the total debt plus minority interest. I'm going to go to the balance sheet. Now I'm going to add in non-controlling interests. And there's another piece of non-controlling interest here. Don't forget redeemable non-controlling interest minus cash. So this is really net debt plus non-controlling interest to be complete. I'm just trying to, in the book they bury this all into one cell, and just to make sure we're keeping this error-proof, I should have separated it out into easier steps. So this is the net debt plus non-controlling interest. Right? That's what you add to market value to get enterprise value. Got it? It's the total debt minus cash plus minority interests. And you'll read over the weekend, really enterprise value is market value plus net debt, less cash, plus also minority interests, preferred securities, other obligations. We'll expand on this next week. So really, to calculate our enterprise value multiple for Walmart, we're going to take the enterprise value, which is the market cap, plus this net debt plus minority interests, divided by EBITDA. You okay with this? Anyone want me to look into one of these formulas?
I'm getting some stuff.
Okay.
I see the balance sheet.
And I took everything from 2012.
Right.
So I took, you have the total debt?
Mm-hmm. That was 5,347.
Yeah, I took that, I added non-controlling interest and the redeemable non-controlling interest.
Right. So
minus cash. Minus cash. Minus 6550. Which is 51727. Yeah?
Yeah, I don't know why it wasn't subtracted that.
Okay. So to calculate the multiple, we don't want the multiple based on that exit year EBITDA. We want the current multiple. We're going to take the market value that we calculated plus net debt, that's enterprise value, market value plus net debt, and let me put that in parentheses because that's the numerator. Divided by EBITDA we can get from the income statement. So EBITDA F21. Oops. That gives us 8.7. Just a proxy for now. We'll soon do comps. We'll look at what the comps range is, but we'll see in some analyses, especially like leveraged buyouts, the current EBITDA multiple of the business is a conservative estimate as to what the value of the to apply towards what the future of the value of the business should be. So we multiply. We take 41851.9 times 8.7. So based on a current, if the company continues to trade at 8.7 times 5 years from now, not higher, not lower, conservative, the company's value at 2017 will be worth $362 billion. We have to discount that back 5 years. Take that value, we discount that back 5 years. So we do equals the terminal value divided by, open parentheses, 1 plus that discount rate to the power of 5. $224 billion. That's the current value of the business, the current terminal value of the business based on the EBITDA method. We'll add that to our 59928 to get the total value of the business. That's the idea. Using the EBITDA method, these are the values of the business we'll use. Everyone have that? Yeah? Anyone want to look at a formula? So now let's see how this specifically comes together. Let's just do this box down here will just help us determine based on each method what the total value is. Let's just do it for the EBITDA method, and we'll go back and do the perpetuity method. So it's asking for the total of the present value of the cash flows. That's the 59528. Sorry, the 59928. And the present value of the terminal value, that's 224,886.5. Will be added to get the total enterprise value, which is 284,814.9. This number won't match the book yet because in the book they have the accurate WACC. We didn't adjust the WACC yet. We got to do our own WACC calculation. We don't have time for that today. That's the enterprise value of the business. It's the sum of the present value of the first 5 years of cash flows plus the terminal value. That's the enterprise value based on our valuation. What's the equity value of the business based on our valuation? Well, we take the enterprise value and we subtract the net debt. The net debt we already calculated on the right, so I'm going to have this equal to the net debt here. So I'm going to, based on our total value of the business, what's the equity value? Just a different way of looking at it. The equity value is the total enterprise value minus the net debt, right? Equity value plus net debt is enterprise value. Enterprise value minus net debt is equity value. Right? So why do we care about equity value now? Because we could take the diluted shares outstanding to get us the implied stock price of the business based on our valuation. So if we pull in the share count, which we've done on the right here, shares outstanding, and we take the equity value is like market cap, and we divide it by the total shares outstanding, we get $69.25. So using these assumptions, our assumptions are going to change. We expect the stock to be around $69, right? Right now it's at 78. We can't analyze it yet, though, until we've honed in on our variables. But I just want to make sure you understand the mechanics so you can start doing this for real. Any questions on that? That's the value based on the EBITDA multiple. Let's look at the value based on the perpetuity. So with the perpetuity method, we first start with pulling in the cash flow, the final projected cash flow, which is 16,427. And then we run the perpetuity formula that you have to memorize based on some growth rate. I'm going to use 1% in the book. Again, this is supposed to represent inflation, some sort of basic increase of cash, which is on standard anywhere between 3 and 4%. That's way too high for now. Let's use 1%. And we'll run sensitivities around this. The terminal value, which is just the formula you have to memorize, is going to be equal to the unlevered free cash flow times, open parentheses, 1 plus the growth rate, 1 plus the 1%, close parentheses, that's the numerator, unlevered free cash flow times 1 plus G, divided by, in parentheses, R minus G, where R is the discount rate, it's 10%, minus the 1%. So F26 times 1 plus F27, whoops, divided by F17 minus F27. That's the value of the business based on the perpetuity. And we have to discount that value to present value. And that present value is going to be equal to the terminal value, again, same discount formula, divided by 1 plus the discount rate to the power of 5. Gives a much, much lower number. But the reason for that is our WACC is a little bit off, and we'll talk about all that next week. One thing to mention, going back to the mid-year, end-year convention, is if we were to use the mid-year convention, so this is 0.5, 1.5, 2.5, 3.5, 4.5, the terminal value, the EBITDA method, sorry, the perpetuity method, that value we would discount back using the mid-year convention, 4.5 years, right? If we're going to use the mid-year convention for the cash flows up there, we need to use the mid-year convention for the perpetuity method. However, the EBITDA method, you will always discount using the end-of-year convention, regardless of whether the individual cash flows were built on a mid-year convention or not. What do you think the reason for that is? Perpetuity is always on the same time frame as the cash flow, because perpetuity is just a series of cash flows. EBITDA method isn't. What's the idea behind the EBITDA method we spoke about 5 to 10 minutes ago? End of your prep question. What's different about the EBITDA method that would lead its discount period to always be end of year convention, independent of what the current cash flows are?
EBITDA uses figure upon your end of year number units after your
Well, EBITDA is over a period.
the basis you use is the end of year basis.
What do you mean the basis is end of year basis?
Like, I mean, on your income statement,
Mm-hmm.
projecting end of year numbers.
But the idea of the mid-year convention is that all that information, when that's translated into cash, doesn't come in a lump sum, right? What do you guys think? Tough question. But there's meaning to it, whether you believe it or not. What's different that we spoke about before about the implication of the EBITDA method versus the perpetuity method. What's the EBITDA method mean? Nothing?
Based on enterprise values, I'm just trying to figure
Based on what?
out enterprise value. So I'm trying to figure out
It's
the multiple.
the multiple is an enterprise value multiple. Yeah, that's the right track. The multiple is an enterprise value multiple. Why? What's the idea behind it?
Well, free cash flow doesn't include debt, where EBITDA is
Unlevered free cash flow, they both include debt, right? They're both unlevered. EBITDA is unlevered. Unlevered free cash flow is unlevered. What else?
Does it have to do with the net debt taken from year-end numbers?
No, but good thinking. More higher level than that. We spoke about it, just reiterating it. What's the idea of the EBITDA method? What's the idea behind it? So the implication of the EBITDA method is, as Paul suggested,
So that there's an exit year?
yeah, is the idea is that you will sell the company, which means what? It's good thinking. Which means what, though? Why would that change the way you're discounting that? It means you're selling the company at the end of 5 years, which means what?
so you have to count all the years.
You have to count all the years. Why?
Because we're assuming that you are selling it at the last day.
Yep, you're assuming that you're selling it on the last day of 2017, so you're getting all that cash in one lump sum, for sure. It's not going to trickle in year by year. We're not going to trickle in over the period, right? The idea of the mid-year convention is we're taking an average, in a way, because we're, in reality, that $15 billion or whatever cash is coming in is not going to come in one lump sum. The implication of or the idea behind the EBITDA method is you will sell everything, the business, in one lump sum. I mean, you won't in reality, but that's the theory behind it. So you will get all that cash in one lump sum, and you'll then discount a full 5 years. So it doesn't matter. I mean, again, this is the theory, right? This is up for debate, but it doesn't matter whether you're discounting the individual cash flows mid-year or end of year. The EBITDA terminal value multiple will be done end of year. The perpetuity method, though, will be in line with how you're doing the individual cash flows. If the individual cash flows is end of year, you do perpetuity method end of year. If the individual cash flows is mid-year, you do perpetuity method mid-year. Okay. So now that we have the perpetuity method terminal value, let's interpret that into total enterprise value based on the perpetuity method, total equity value, and total stock price. So we're going to take, again, from the perpetuity, we're going to take again the total present value of cash flows, which is the 59928.4. We're going to take the present value of the terminal value, which is much, much lower, but again, we have to adjust. This will change when we make a more accurate WACC, and we'll talk about that. We'll add the two, so $174 billion. We'll take the net debt that we calculated here on the right. We could have also taken it from the left. And so the total enterprise value minus the net debt is 122,666.3. So the equity value is the total enterprise value minus the net debt. And we'll pull in the share count because we'll divide the equity value by the shares to get the implied stock price, which is $36.45. Way low, too low. Doesn't make sense. The reason is our WACC is off, and we'll explain what that means. Our WACC is too high. But we'll discuss that. But these are the mechanics. That's the important thing. So that's how it's done.
You mentioned that you want your EBITDA method, estimated value per share, so your method would be almost the same.
Ideally, they'd be in line.
Right.
The EBITDA and the perpetuity value. What is making? Well, I told you what's making these out of line. It's the WACC, and it's tough to discuss that until we understand fully where the WACC comes from.
Yeah.
But the EBITDA method is more or less based on the market. It's based on the multiple. The perpetuity method is more or less based on your model, based on cash flows. That's going to be the difference. So if the value of the market is in line with the value of our model, then this should be in line. That's the idea. That's the ultimate goal. So next week we're going to talk about the WACC, what the WACC means. We're going to apply it to this, really interpret the valuation based on DCF, and then we'll go to the other methods of valuation.